So recently, there's been a lot of talk about rising interest rates. And if you're looking to buy a home, a lot has changed over the past couple of months and even couple of years. So it's super important that you know all the changes and how rising interest rates will affect your home buying process. And we all know about the historical inflation that we're experiencing because demand is just too high and supply is constrained and cannot keep up with the current demand. So to combat this, the Federal Reserve, the United States Central Bank, is increasing the federal funds rate, which is the interest rate at which banks borrow and lend to one another. The Federal Reserve typically will raise the Fed funds rate when inflation is just too high because higher interest rates increase the cost of borrowing, which would slow down demand and economic growth. And while the Fed funds rate is not the rate that consumers pay, you don't see the Fed funds rate or pay that, changes in this rate will still affect the borrowing and savings rates consumers see every single day. One of the things that will be affected by this increase in the Fed funds rate is mortgage rates, which in turn will affect housing demand. So how are mortgage rates affected by the increase in the Fed funds rate? Well, it's a little complicated, but we'll explain it step by step in this video. And to a large degree, mortgage rates are actually determined by investors in mortgage-backed securities. 2008 flashbacks here. However, don't worry, the Fed's interest rate hikes will greatly affect the investor's decision to buy mortgage-backed securities. For the purposes of this video, we'll refer to mortgage-backed securities as MBS. Now, you may have heard of those mortgage-backed securities, MBS. They were the product that played a huge role in causing the 2008 financial crisis. Here's how they work. Mortgage lenders do not usually keep the loans that they fund. Instead, they'll sell them to investors. For example, let's say a lender makes a $200,000 home loan that will eventually yield $250,000 in its lifetime through principal and interest payments. They'll sell this loan to investors at a discount. For this example, let's say the lender sells this mortgage to investors for $225,000. This lets the lender take its profit up front and fund another mortgage with the money. Meanwhile, the investors pay $225K for the right to collect $250K over the course of the mortgage. Theoretically, both sides win on this agreement, but because buying just one mortgage is way too risky and expensive, investors will buy a share of a group of mortgages. You can almost think of it like buying an S&P 500 index fund, as this consists of the 500 different companies in the US index. These shares in a group of mortgages are known as mortgage-backed securities, or MBS. Like bonds, mortgage-backed securities are sold in $100 increments, and their price can increase or decrease based on market demand. Let's say an MBS is priced at $100 and pays a 5% coupon rate. This means that you'll be paid $5 in interest each year. Then, let's say that inflation is really high and investors do not want to buy an MBS that pays them a yield less than the inflation rate. It's only logical. So if investors sell their MBS, the prices will fall to, based on supply and demand. And because that $5 interest payment remains the same no matter what the price of the MBS is, the yield will actually increase to around 6.7%. On the other hand, if the economy is becoming unstable and stocks are falling as a result, investors might be more interested in buying an MBS. As more people purchase MBS, the prices go up as a result. To continue the example, let's say that the MBS is now priced at $125. This means that the yield on the MBS will decrease to 4%. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. All right, so you might be wondering, this all sounds a bit complicated. I agree. Why does the price and yield of a mortgage-backed security matter to me, and who's actually buying these mortgage-backed securities? According to the Federal Reserve Bank of New York, depository institutions, aka banks and credit unions, are the largest class of investors, holding about 32% of the total mortgage-backed security market. They're followed by the Federal Reserve, international investors, mutual funds, and then money market funds. If you're interested in any mutual fund or have money in a money market fund, chances are that you own some mortgage-backed securities. Mortgage lenders closely monitor the price fluctuation of the mortgage-backed securities every single day. And when the price of an MBS drops, lenders will raise interest rates. And when prices increase, lenders will drop the rates. Lenders will generally react faster to price drops rather than price increases, because lending money at below market rates will cost lenders serious money long term. During the pandemic, the Federal Reserve injected massive stimulus into the economy, including large-scale purchases of US Treasuries and mortgage-backed securities. And from March 2020 to April 2020, the Fed purchased a total of $580 billion in mortgage-backed securities and has since averaged around $114 billion per month. This unprecedented level of buying pressure in the mortgage-backed security market drove prices up, thus leading to lower yields and record low mortgage rates. In March of 2022, the Fed finally ended its shopping spree, ending a total of around $1.4 trillion worth of mortgage-backed security purchases. And as you can see in this graph, of the average 30-year fixed mortgage rate, it steadily declined during COVID before recently spiking to levels not seen since, 2008 again. With less buying pressure in the mortgage-backed security market and inflation at 40-year highs, the market was fearful of holding mortgage-backed securities and began to sell them at the beginning of 2022. As inflation got worse and the Federal Reserve began to act more aggressively with the interest rate hikes, mortgage-backed security prices declined and yields jumped, leading to higher mortgage rates. And here we are. On December 30th, 2021, the average 30-year fixed mortgage rate was about 3.11%. They're now in mid-2022 at around 5.81% and continuing to rise. To show you how big of a difference this is, let's go through an example. So let's say you get a $400,000 loan, a mortgage, with a 30-year fixed rate mortgage at 3% interest rate in January of 2022. This would cost you about $1,686 per month, excluding taxes and other fees. The total payment over the 30 years would total to about $607K, with $207K of that being interest. Now, let's say one of your friends get the exact same loan today with a mortgage rate at 6%. The same mortgage would cost approximately $2,398 per month and over $863K in total, with $463K of that being interest. A 6-month swing in mortgage rates would result in a 42% increase in overall monthly repayments. That's absolutely wild. With inflation still so high, the Federal Reserve will continue to raise interest rates and thus mortgage rates will rise as well. And in fact, the market is pricing in 4 more rate hikes for 2022, with large jumps in mortgage rates leading to massive increases in the all-in cost to own a home. The housing market demand has decreased substantially. Here are 2 graphs from the Federal Reserve. This graph shows existing home sales, which since January of 2022 have fallen substantially. This next graph shows new single-family house sales, which, as you can see, suddenly jumped when the big pandemic first started and has steadily declined since then. As home prices continue to hit record highs and mortgage rates tick up, it's likely that demand for houses could continue to decline dramatically. Real estate startup HomeLight found that about half of prospective home buyers were hitting the pause button on their plans to buy a home, choosing to wait for 6 to 12 months before restarting the process. Meanwhile, according to the Mortgage Bankers Association, mortgage applications fell to the lowest level in 22 years. And while this all sounds a bit depressing, there is a silver lining to it all. So if you're looking to buy a home, what does this all mean for your home buying process? All right, since higher mortgage rates will reduce the amount of prospective buyers, this could help ease some of the tight housing supply problems that are happening across the country. According to Realtor.com, the gap between single-family home construction and household formation is at 5.24 million, meaning way more people want to buy a home than what's being built. The demand is higher than supply. And between 2015 and 2020, the average rate of household formation was 1.5 million households per year, while the average rate of home completion was about 806,000 homes per year. If building and housing formation were to continue at this rate, the gap would never close. We're structurally underbuilt here in this country, which is leading to the crazy home price growth we've seen over the past couple years. And so while higher mortgage rates would or could reduce the number of people interested in buying a home, it is possible that home prices will not come collapsing down and will instead just slow down a little bit in price. Whatever may happen to home prices, a year or so of slower demand could give home builders some extra time to catch up on the demand, which in the long term can help slow home price growth and give buyers, you, more affordable options. Now, there are two main types of mortgages: fixed rate and adjustable rate. And they mean exactly what they're called. So the term fixed rate mortgage refers to a home loan that has a fixed interest rate for the entire term of the loan. Once you agree to the mortgage, the interest rate will not change with the market. A fixed rate mortgage is great for home buyers that want predictability and want to know exactly how much they'll pay each month. Fixed rate mortgages can be both good and bad depending on the projected future of the economy. If interest rates are expected to rise, like what's happening right now, home buyers will typically try to lock in lower rates to save money over time. That way, when rates rise, they can maintain a lower payment relative to the current rates. On the other hand, if interest rates are likely to fall, a fixed rate mortgage could end up causing you to pay more on your mortgage than what the current market is offering. Basically, if you want to buy a home but rates are likely to go down in the future, you could get an adjustable rate mortgage that will account for the future interest rate decreases. It's a bit speculative, but it's one strategy. And speaking of adjustable rate mortgages, these are home loans with a variable interest rate. So when you agree to an adjustable rate mortgage, the initial interest rate is fixed for a certain period of time, which could range anywhere from 1 month to 10 years. And after that, the interest rate will increase or decrease periodically at yearly or sometimes monthly intervals, depending on current market conditions. Usually, the initial interest rate for an adjustable rate mortgage is fixed at a lower rate than the interest rate for fixed rate mortgages. However, after the initial interest rate, there is a chance that the rate could move higher or lower depending on the overall market and economy. When you're shopping around for adjustable rate mortgages, you'll typically see figures like 7/6 or 5/1. The first number refers to the number of years that the interest rate will be fixed for, and the second number refers to how often the rate will be modified after that. If the second number is 1, your rate will adjust every year. If it's 6, your rate will change every 6 months. It's important to know that ARMs, adjustable rate mortgages, have a lifetime cap or a ceiling, which means that the lender cannot increase your interest rate beyond the predetermined ceiling. All right, so what's the point of all this? Which of these mortgages should you choose or look for? It's not this simple, but we'll try to break it down. If you're planning to stay at your home for a long time, mortgage rates are low, you don't want to take any risks, and you just want to have peace of mind, you might consider the fixed rate mortgage. Adjustable rate mortgages can be quite complicated and can add risk to your financial picture if you don't fully understand the structure of that mortgage. If you're buying a home that you plan on living in for the foreseeable future, having predictable payments could just bring less worries and will be easier to budget around. On the other hand, you should consider adjustable rate mortgages if you plan to move in a couple years or want more flexibility. And if you choose an ARM, adjustable rate mortgage, with the plan to move soon and you end up staying longer than expected, you can still refinance your loan into a fixed rate mortgage. Even if you don't know when you plan to sell your home, the lower monthly payments during the fixed period can help save you money. If you do plan on getting an ARM, adjustable rate mortgage, be sure to know how it works. For example, ask your lender how often your rate increases and what is the max rate that you could end up paying. Ultimately, picking between a fixed rate mortgage and an adjustable rate mortgage depends on your personal plans with the house and your opinion on how high mortgage rates might go. With the housing market and overall economy entering a transitional period, it's probably best to slow down and consider all of your options. And with everything changing so fast in 2022, it's likely that there's no rush to purchase a house right now. Thanks so much for watching. I'm Tony from Wealthfront. Take care.